The way to minimize risk is to take a safer position in the capital stack. So this is showing the different types of money that typically come into EB5. A lot of times in a development project, you'll have a senior loan, which will be around half of the project costs. And then a lot of EB5 is either mezzanine debt or preferred equity. So a mezzanine loan is like a second position loan. If the developer defaults and doesn't repay, then the senior loan is the first that gets repaid. The mezzanine loan is the second that gets repaid. And then it goes to preferred equity, and then it goes to developer equity, which the developer equity, if you're investing there, if the project loses a single dollar, you're going to lose money out of your $800,000. Versus if you're a senior lender, the developer would have to lose everything. If there's mezz or preferred equity behind you, they would have to lose everything before you would lose a single dollar. So that's why senior debt is the safest position, then mezz, then preferred equity, and then common equity. Now in EB5, you're only going to maybe see like a 3 or 4% return in common equity projects. And that's usually money that you would see a 20 to 30% return on. And so we just cannot find enough investors who are willing to take that much risk for that little return. And that's why we don't typically do pari passu common equity projects in the EB5 program. We like to stick to either mezz with a lot of equity or senior lending, which all of our current rural projects are. This is showing some past projects. This is a senior loan and a mezz loan that we did. This is the Nine Orchard Hotel in New York City. We lent $88 million on this $223 million project. So the developer put $135 million of equity in. Essentially, this developer would have to lose this $135 million, and we would have to take over the deal before we lost any money for the EB5 investors. So as long as we could take over the deal and sell it for 40 cents on the dollar, every investor would be repaid. And the asset would have to be worth $0 for the EB5 investors to lose all their money. Here's another project where we had a high equity model, but we were mezz. So we had a senior loan of $175 million, and then $63 million of EB5, and then $196 million of equity supporting us. So the developer would have had to lose this equity before we lose money as a mezz lender. Now, if this project was already successful repaid, this is another project in Big Sky where we're currently doing some raises on the Yellowstone Club phase 2. But if the developer was to default on this mezz, then on this, which it won't because it's already been repaid, it was successful.